A short put is an option strategy where you sell the right for someone else to sell you stock at a set price. When you sell a put, you are taking on a specific obligation to buy shares if the price drops below your target. Remember that each contract usually covers 100 shares, so your commitment could be larger than you expect. You collect a cash premium up front. In exchange, you agree to buy the stock if it falls below your strike price. Unlike buying stock directly, a short put limits your gain to the premium collected but commits you to a future purchase. Your maximum profit is capped at the premium received, while your risk is tied to how far the stock price falls. Many investors only use this strategy on companies they already intend to add to their portfolio, just at a lower price point. Options trading involves significant risk. Always research your strategy thoroughly. Thanks for watching, and see you in the next lesson.